Hello everyone, in today's webinar series we will be discussing MT4, a popular trading platform used by Forex traders worldwide and developed by the MetaCode software. Let's begin. So in today's presentation, we will address the following topics: what is MT4, how to use it, the different order types and execution orders that we can take, the key terminologies, and how to manage our profit and loss. So let's start. Obviously, the platform is widely regarded for its user-friendly interface and advanced features. It's a flexible tool for traders to execute multiple orders, including market orders, limit orders, stop orders, making it highly flexible for traders. And one of the standout features of MT4 is its ability to support third-party plugins and custom indicators, which we'll also be talking about later. So this is one of the most used systems in the as a trading platform, and here in Equiti we use the system and we also use MT5. And the platform's highly secure, and you can take long and short positions very quickly. Buying a contract from the euro against the dollar, it takes a few seconds only to execute, and maybe even execute it on the same second, depends on the order limit. So it also provides everything that traders need into the global financial markets, from direct execution and orders, and allowing risk and profit control as well. So as I mentioned before, that we here in Equiti we use both MetaTrader 5 and MetaTrader 4. And now let's talk about the types of positions that we can take. So as a new trader, you will understand that there's two things to Forex trading: the base currency and the code currency. And these are two currencies involved in a currency pair, and they represent the two currencies being exchanged in a trade. The base currency is the first currency listed in the currency pair, and it is the currency being bought or sold. It's important to understand the relationship between the base currency and the code currency when trading, because it determines the value of the currency pair and the profit or loss of the trade. The exchange rate between the two currencies is constantly changing, which provides opportunities for traders to profit from the fluctuations in the currency values. So let's take a look at an example here in case of the Euro USD, which is the most traded pair. If a trader expects the price of the Euro USD pair to rise from 120 to 125, it means that he expects the Euro to rise against the USD, the dollar to fall against the Euro, and in any case, the price will be targeted to rise. In this case, the trader will buy the Euro at the same moment and sell the dollar through a buy order, which is scientifically known as the long. So as traders, we kind of look at the prices to see or to speculate whether it's going up or down. So if the euro is going from 120 to 125, then we speculate that the price is going up. So here we can buy, and it's in another term we can call it as a long as well. Now, buy position, which again we refer to as long sometimes or occasionally, taking a long position means buying the base currency and selling the code currency simultaneously. And the buy is made on the base currency. This position is taken when the trader expects the price of the asset to rise, like I mentioned, from 120 to 125. That is, the base currency will become of higher value than the corresponding currency. To dismiss confusion here, we're just looking at, basically, we're buying the Euro USD pair. So what's important for us is to understand that the base currency is the Euro and the code currency is the USD, and that these two currencies are involved in the buy and sell of your order. So for example, if you know that the Euro USD is going up, that means that the dollar in return is simultaneously actually going down. So this is why it's important to know the difference between the base currency and the code currency, just to have it in the back of your mind. So moving on to sell position, which we also call here short. A sell position is known as short selling, and again, it's two positions taken simultaneously, but here the purchase is executed on the code currency and the sell is made on the base currency. So here you are selling the euro and you are buying the dollar. Thus, it's a position taken when the trader expects the price of the asset to fall. Let's move on to contract sizes. A contract size refers to the notional amount of a currency pair that you are trading. It is also known as a lot size. You may hear this a lot. That traders always use. How many lots have you used, or what's the lot size in your account, or like in your orders? So the contract size determines the value of each pip movement, which is the smallest price change that a currency pair can make. The contract size you choose depends on your trading strategy and risk management plan. Obviously, if you have sufficient capital in your account, then that means you can exceed the lot sizes that you wish to make. But if your initial capital in your account's really small, then you need to use really small lot sizes. Trading larger contract sizes can potentially yield larger profits, but it can also increase the risk of losses, and that's why lot sizes are super important to consider and compare it to your initial capital size in your account. So even though you can use leverage and you can use a lot of volume on your account, you need to refer back to your initial capital, and that's how you kind of manage your risk. So trading smaller contract sizes reduces the risk of losses, but also limits the potential profits. It is important to consider your trading style, risk tolerance, and account balance when deciding on the contract size. There are 3 types of lot sizes: standard lot, mini lot, and micro lot, as we can see here. Standard lot is the largest contract size and represents 100,000 units of the base currency. For example, if you're trading the Euro USD currency pair, a standard lot would be 100,000 euros. So in fact, you are trading 100,000 euros out of this Euro USD pairs, which makes sense because you're making that much profit. So obviously you're not just trading 1 euro. For the mini lot, it's the 10th the size of a standard lot and represents 10,000 units of the base currency. For example, if you're trading the Euro USD currency pair, a mini lot would be 10,000 euros only. Now we also have a micro lot. A micro lot is 1/10 the size of a mini lot and represents 1,000 units of the base currency only. For example, if you're trading also the Euro USD, a micro lot would be 1,000 euros. Now we have different types of orders that I need to take you through as well. But first here, let's talk about the different types of contract sizes. Like I just mentioned, this is for the euro. So if you are buying one standard lot of euro, you are taking 100,000 units. And for a mini, it's 10,000. And for a micro, it's 1,000. For gold, it's 100. For a standard, 100 ounces, you're buying for a standard lot. For a mini lot, you're buying 10 ounces. And for a micro lot, you're buying 1 ounce, which is 1,000 micro lots. For silver, it also has its own different value and number, and which means 5,000 for a standard lot, 500 for a mini lot, and 50 for a micro lot. For oil, it's also different. So for each product, you will notice that each product has its own unit value. And therefore, it's important that you know how much you are risking and how much your order type actually has. So for a standard lot, for oil, that means you are buying 1,000 barrels. And for a mini lot, it means you're buying 100 barrels. And for a micro, you are buying 10 barrels. So let's move on to the different types of market orders. There are initially 3 market orders or types of order that you can actually execute, and they are at the benefit of your trading. So a market order is an order to buy or sell a currency pair at the current market price. You open your account, you press execute, you're buying at the current market price. Market orders are executed immediately and are useful when traders want to enter or exit a position quickly. We also have limit orders. A limit order is an order to buy or sell a currency pair at a specified price or better. Limit orders are useful when traders want to enter or exit a position at a specific price rather than the current market price. And we also have a stop order, and a stop order is an order to buy or sell a currency pair once it reaches a specified price level as well. Stop orders are used to protect against losses by automatically closing a position when the market moves against the traders. So not only that you can buy at the current market price, no, you can also specify the price that you want to enter the market or exit the market. And that's what's really beneficial when using these types of order. So obviously the easiest is to just to execute the order at the current market price. But if you want to buy at a higher price or sell at a lower price, you can also do that. So it gives you basically that privilege to do so. So here we have the different types of limit orders and stop orders that I just talked about. So a buy limit is used to execute a purchase at a lower price than the current market price. So let's say you don't want to execute the price right now. You think that the price is going to go lower and you want to benefit from the lower price. So you do a buy limit order. The sell limit is the opposite. You want to sell at a higher price than the current market price. So you wait for the price to go to level up and then you sell from that price. You can also do that. For buy stop, a buy order that you place if you want to buy at a higher price than the current market price, and the sell stop, controversially, is the opposite, and a sell order you place if you want to sell below the current market price. Now, take profit order is another thing that you will see when the MT4 is open, and the stop loss. Take profit order is an order used to set a specific price at which the deal is automatically closed and the profits achieved are sufficient. So let's say you don't want to keep your order floating, you actually want to log off and you want to just go, so you want to put the price at which you can take your profit and exit the position that you've taken. This is the take profit order. And a stop loss is if, let's say, the market went against you and you bought at you bought at 120 for the USD, hoping that it will go at 125, but the price reversed and it went to 119. So you can put your stop loss at 118, so you can lower the amount of losses that you are taking. Stop losses are very important for risk management. So here, this is a picture just to show you guys how will they look like when you take your orders. They will be visible to you so that you can see that you can also alter it when you want as the market moves. So closing positions. Closing the trade, whether it's long or short, means that you are reversing the initial position. Thus, if you're closing a position of buy, you are selling the base currency and buying the quote currency. Buying GBP USD, which is the British pound, will consist of buying the GBP and selling the US dollar. Buying and selling is carried out simultaneously at a specified price. And this is why it's called pair trading, because you are buying one and you are selling one. When a trader closes a financial position through close, it means that the system will reverse previous positions so that the entry of the closed position is selling the GBP and buying the US dollar. And this is why market prices are always and constantly moving up and down, even if it's just by a limited number of pips, because people are constantly buying, selling, and closing position, which also impacts the price movement. So this is a mobile phone screen for your market execution. It's very simple to use. At the top here, you will see that you can buy or sell at the current market price, or at the market execution, you can also do a limit order or a stop order. So you can do automated stop loss order and take profit as well. Here you can put your stop loss. Obviously, not all traders use the stop loss, but we recommend the use of stop loss just in case the market went against you by a lot. Like when it happened with the GBP USD, when it hit a free fall all the way to beyond levels of 109 when it was at like 118 or 114. So sometimes markets can just fall sharply, or you're going to see sharp increases or declines. So this is why it's very important to use stop loss. And for take profit is that, let's say you bought at 16.98 and the price went at 117, but then it fell right away. So if you take a take profit at 117, you would have benefited from that order in case of, again, the market going against you at your buy position. So another screen of viewing orders and positions on the phone, and this is the account details. You will have the account details here at the beginning, profit and loss, your positions of what you take. So this is what I was saying about lot sizes, and this is will be in the volume column when you open your screen, and you can buy limit or sell limit, or you can buy stop and sell stop, or you can buy at the actual market price. So this is basically where you hit the positions pending order screens. This is the charts, and these are the codes. You will see them at every platform that you have on MetaCodes. So for the GBP/USD, there's a base and quote. Like I said, the first currency listed to the left is the base, which is the British pound. This is the base currency. This is the quote currency. Pairs are always quoted in pairs, basically, and currencies are always priced in pairs, and you can buy one currency and sell another at the same time. So, key terminologies. PIP. A PIP is a measure of the movement of currency pairs and represents the fourth decimal digit in the price exchange rate. So, even though the prices may not see sharp or intense movements, like the price doesn't have to go from 120 to 121. No, it can have, like let's take the AUD USD pair example. You can see a slight change from 50 to 80, and that kind of gives you a signal as to where the prices are heading. So pips are also as important. And let's say the price moved from 50 to 80, which means that the price has risen by 30 pips, and that's how we calculate our pip value. So the only difference that we have in pip values is the USD JPY pair, that it only has a different kind of Q for pip. So the USD JPY, if it moves from 115.30 to 49, it means that the price is moving by 1.9 pips. So the USD JPY is the only currency pair that actually has a different pip representation. So pip value, the value of a pip is determined by two basic things: trade volume, which is the contract size. Like I mentioned, it's also the lot size, and the exchange rate of the currency pair. To calculate the value of a pip, divide one pip, usually 0.0001, by the current market capitalization of the FX pair. Next, multiply this number by the contract size. The contract is the number of the underlying units you trade. So it's a simple equation, really. So let's just move on to it as well. So since the US dollar is used as a measure of currencies, you'll see that most major currencies are quoted against the US dollar, and they're also the most traded, but there's also cross pairs that we will talk about in a later date. And since the contract size is 100K of the base currency, therefore it's easy to calculate the pip value, which is always $10. So because the value is 0.0001 is the primary driver, for example, a trader took 3.18 lots on the Euro USD. How much is a pip in this position? So the pip price in the direct pair is $10 for let's say one lot. So the price of one pip in the position taken by the trader is 3.18 times 10, which is 31.8 USD. The equation means pip decimal number multiplied by contract size gives you the number of your pip value. For indirect currency pairs, the dollar is the base currency, such as the USD CHF. This is for Switzerland. And pairs should be a reverse and make the dollar the quote currency. For example, USD CHF 0.9100. To reverse the CHF currency pair USD, you have to divide by 1. So pip value is basically 0.111 multiplied by the 100,000 units of the pips that you bought, or the lot size that you bought, and times multiplied by 1.099, it gives you $10,000, 98 and 9. If you get confused at this stage, there are later several webinars that will explain this in detail. But I'm just giving you a little brief about how MT4 really works in case you do want to go into the advanced section of it, but I just don't want to make it seem complicated when it's really kind of simple. So leverage. I'm sure all of you want to trade with leverage, and a leverage is when a broker supplies you with money so you can maximize your position beyond your initial capital. It is expressed in proportions, for example, 50 colon 1 or 100 colon 1. If you're trading as successful, your profits will be doubled, but be aware losses can also be maximized. So you can be liquidated out of your account in case you trade, let's say times 5 your account, and if you actually lose, then definitely you will have no money left in your account. So that's why it's really important when you're using leverage to have already more initial capital than the ones you're trading with. So let's say that you make $50 a trade. If you use 101 leverage, this multiplies your trade 100 times. This means that $50 times 100, you are trading with $5,000 in profit. Your trade is now worth 5,000 instead of 50, and any profits you will make will be greater and by the same ratio. But if your trade was unsuccessful, your loss will also be 100 colon 1 greater. Therefore, what's really important here is to have the initial capital in your account more than the risk that you're taking. So definitely take a look at your risk tolerance before using such an immense type of leverage. So margin. When you open a short or long position, the broker holds a portion of your account equal to the contract value divided by leverage. This is called used funds or required margin. It's right here. So for example, if your account has $10,000 and you want to buy 5 lots of GBP USD at 125,181, the contract value is leverage is 1,500 because you you are buying 5 lots, and one contract is 100,000, and 5 times 100,000 is 500,000. So you are now trading by 5 times the money that you had. And this is where your margin comes in, just to kind of see that if you're going above the margin level, then that means that you are getting more risky. So 5 lots for the GBP USD is actually equals to 500,000 units. So finally, I would like to discuss with you guys the profit and loss calculation. A trader decided to buy 3 lots of the GBP USD pair, which, as I previously mentioned, is the British pound against the US dollar, starting the position at 1.1270 and closing the position at 1.1480. So it's definitely a buy position. 3 contracts means 300,000. Your pip value here is 10. Your spread is closing price minus opening price, which gives you 21 pips. And the formula, number of pips times pip value times position size, is 21 times 10 times 3 is $6,300 in profit. Also, just make sure that while you're calculating your profit sizes, that you know that if the market went against you, you can always use stop loss to limit these losses that you are making. I hope you guys enjoyed this session of Introduction into MT4. Stay tuned for the next technical analysis series.